Moderna Inc., trading under the ticker MRNA on the NASDAQ, is currently at 32.36 USD, showing a slight uptick of 0.070 or 0.22% in intraday trading today. While that might look like a quiet session for a stock that has often seen double-digit swings, there is a massive disconnect between the current price action and the internal engine of this company. Most people looking at their screens today see a biotech giant that has lost its way after the global health crisis, but the real story is found in the capital reallocation we are seeing behind the scenes. While the market is obsessed with the decline in vaccine uptake, Moderna has quietly secured over $54 million in fresh funding from the Coalition for Epidemic Preparedness Innovations, specifically for a Phase 3 trial of their bird flu vaccine. This is the first time an mRNA-based pandemic influenza candidate has moved this far, and it suggests that while the retail crowd is jumping into Nvidia stock for quick gains, the institutional heavyweights are looking at Moderna as a long-term infrastructure play for global health. The common narrative you'll hear on most investing sites or in a typical individual brokerage account discussion is that Moderna is a one-hit wonder. People look at the massive drop from its all-time highs and assume the business model is broken. The expectation is that without a mandatory global need for their primary product, the revenue will simply dry up until the cash pile is gone. However, the reality is much more complex. This company isn't just waiting for the next pandemic, they are actively trying to recreate the entire seasonal vaccine market. If you've been using a Fidelity mobile app or checking your Robinhood app lately, you've probably noticed the biotech sector has been under pressure, but Moderna's aggressive cost-cutting measures, including a 10% workforce reduction earlier this year, are designed to push them toward a cash break-even point by 2028. They are shifting from a high-growth, high-spend experimental phase into a lean, disciplined biotech powerhouse that targets oncology and rare diseases with the same tech that made them a household name. Looking at recent stock movement, we saw a pretty sharp 7% drop just yesterday. That was largely driven by news of the CEO's expiring stock options and a general sense of unease in the biotech space as political leadership changes sparked questions about future drug pricing and FDA standards. However, the bounce we are seeing today, though small, indicates that some investors are starting to see value at these levels. If you look at institutional activity through an interactive brokers platform, you'll see that while some large funds like FMR LLC have trimmed their positions significantly, others like BlackRock and Vanguard have remained relatively steady. They are essentially betting on the pipeline. The trading volume has been elevated recently, showing that there is a high degree of conviction on both sides of the trade. This isn't a stock people are holding with indifference. They are all in on the future of mRNA technology, or they are convinced the company is headed for a $22 floor. When you use tools like Schwab Intelligent Portfolios or other forms of automated online investing, these systems often weight companies based on historical volatility and current debt-to-equity ratios. Moderna actually looks quite strong on paper in those specific areas. They have a debt-to-equity ratio of only about 6%, which is incredibly low for a company with a $13 billion market cap. They have roughly $6.5 billion in cash and investments, giving them a significant runway to fund their 40-plus development programs. This financial stability is something that often gets overlooked by the casual investor who's just looking at the daily price change on their Robinhood Investments tab. The company is using that cash to pivot into a seasonal franchise that includes RSV, flu, and COVID combination shots. They want to own your medicine cabinet every autumn, and that kind of recurring revenue is exactly what long-term wealth management strategies seek. If you are managing your own individual brokerage or using a Fidelity trading platform, you know that biotech is a game of binary outcomes. Either a trial succeeds and the stock rockets, or it fails and the floor falls out. Moderna recently faced a setback with its CMV vaccine, which failed a key study, and the market punished them for it. But that is the expectation for this sector. The reality is that they are still on track to expand their seasonal vaccine products from 3 to 6 by 2028. They are targeting readouts from 9 different Phase 2 and Phase 3 studies in oncology alone. This is where the tension lies. The market is pricing Moderna like a failing vaccine company, while the pipeline suggests they are becoming a diversified oncology firm. When the reality of these clinical trials starts to hit the tape in 2026, the current $32 price point might look like a massive mispricing of assets. Comment below how many shares of Moderna stock you currently hold, or if you are waiting for a lower entry point before you decide to invest online. To understand where Moderna is going, we have to look at what they actually do at a fundamental level. They don't just make vaccines, they are essentially a software company for biology. Their mRNA platform allows them to code instructions for human cells to produce specific proteins. This business model is high margin and highly scalable. Unlike traditional vaccine manufacturing, which requires massive bioreactors and months of cultivation, mRNA can be developed and scaled in a fraction of the time. This is why the bird flu funding is so significant. If a new strain of influenza starts to spread, Moderna can have a candidate in Phase 3 testing, while traditional manufacturers are still trying to figure out which egg-based strain to use. This speed is their competitive advantage, even if the current market sentiment doesn't reflect that value. They are currently pulling in about $1 billion in quarterly revenue, which is a far cry from their peak, but still enough to keep the lights on and the labs running while they wait for their next big approval. The macroeconomic pressures cannot be ignored either. High interest rates have historically been a headwind for biotech because these companies rely on the future value of cash flows. When you can get a guaranteed 5% return in a money market account through your Fidelity brokerage or SoFi investing account, a risky biotech play looks less attractive. But as the interest rate cycle shifts, we could see a rotation back into these risk-on assets. Investors who have been hiding in safe havens like Apple stock or Tesla stock might start looking for undervalued opportunities in the healthcare sector. Moderna fits that description perfectly. It is a beaten-down leader with a proven technology and a pile of cash. The risk, of course, is that the public's appetite for vaccines continues to wane, or that a competitor like Pfizer or a smaller firm using an interactive broker's account to trade aggressively finds a better delivery mechanism. In the final section of our analysis, we have to look at the catalysts that could move the needle in the next 12 months. We are looking at a potential Phase 3 start for the H5 pandemic vaccine in early 2026. We are also expecting more data on their flu and COVID combination shot. If they can prove that a single shot is just as effective as 2 separate ones, they will likely dominate the seasonal market because of the sheer convenience for patients. Furthermore, their work in the individualized neoantigen therapy space with Merck is perhaps the most exciting part of the story. They are trying to create custom cancer vaccines for specific patients. If that even partially works, the current market cap of $13 billion will seem like a rounding error. This is why you see so many professional traders on the Fidelity trading platform keeping a close eye on these specific clinical milestones. For those of you who prefer a more hands-off approach to self-investing, perhaps through a SoFi robo-advisor or a similar online investment service, Moderna represents a classic deep value or turnaround candidate within the biotech space. The gap between what people believe about the company, that it is a relic of 2021, and what the data shows, that it is a leaner, more focused entity with a massive pipeline, is where the opportunity lives. You don't get these kinds of dispricing discrepancies in stocks like Nvidia stock or other high flyers because every piece of good news is already baked into the price. With Moderna, the market has almost priced in a total failure of the pipeline, which seems unlikely given their track record of delivery. The outlook for 2026 includes a target of 10% revenue growth and a further reduction in operating expenses by about $500 million. This disciplined execution is what will eventually win back the trust of the analysts who have been skeptical. When you use investing sites to compare Moderna to its peers, you see a company that is actually leading in efficiency despite the net losses on the bottom line. They are narrowing their revenue guidance and focusing on the markets where they have the strongest foothold, like the US and the UK, through long-term government partnerships. These partnerships provide a level of revenue visibility that most biotech companies would dream of, yet the stock continues to trade at a level that suggests total uncertainty. Self-investing requires a certain level of emotional detachment, especially with a name like this. It's easy to get caught up in the headlines or the political debates surrounding health policy, but the numbers tell a different story. If you're using a Robinhood app to track your portfolio, you've seen the volatility firsthand, but the savvy investor looks at the intraday movement of $32